I think so. It's 10:31 here, so we'll get this show started here. I'd like to thank you guys. This is Jeremy Brown and myself would like to thank you guys for all showing up here this morning. So today we've got we have some updates for some new changes to the Prudential product that has just come out over the last couple months here. And then also we're going to run through a whole bunch of other product updates and stuff for the year end here from different carriers and stuff. So I think the first thing what we wanted to do is just to pass it on, or to start off with Kailee Davis from Prudential, and basically talk about some updates that she has with respect to her product. So, hey Kailee, how you doing? Oh, I can't hear you there, Kailee. Kailee, now can you? Unfortunately, Kailee, I hear you. Oops. Look, beautiful, the great technology. So while we're waiting for this, or trying to figure this out here, is that just some of the things that I wanted to touch upon here for this is with respect to some updates and stuff, is that people have seen in the that people have that have come up is that over the past couple of days we've had there's been some emails going out about Marketing Pro. Marketing Pro and FMG has merged. The two programs have, or basically FMG has purchased Marketing Pro, and with respect to that is basically, so what's happening is the merger is starting to take place here in December. So what basically, if you had a premium service with Marketing Pro, basically the access to the library or their Marketing Pro email system, is that with respect to that is basically what will happen is that you have already received an email, and basically your new account will be set up and be merged over into a new FMG platform. For people who were just using FMG or for using Marketing Pro just for the advertising, for the ad submission portion of the product, is that basically really nothing is going to change at this point in time. Basically, you're going to be maintaining the same login. You're going to be doing the same things over and over. So nothing is going to change for the people who are just using it for ad submission purposes only. But for people who are utilizing it for a premium service like the access to their library or the Marketing Pro, for the email campaigns and all in the email campaigns, letter campaigns, all those types of things, your systems are going to be changing, and from that we will be able from there that will all start. You're going to be starting to receive some more emails here in mid-November. At the same token, that stuff will start converting start the conversion in early December, and basically so that a time frame so that at the end of the year, basically you will be off of the old platform for Marketing Pro. Just trying to see if we can connect back to Kailee here. Then, like I said, we're still working through that. So other changes that have happened over the last or recent changes and stuff for that is one of the big things is that for people who are doing advisory program from American funds, we've had a conversation on our marketing or on this webinar in the past, is that basically the F2 Direct program from American funds, that program has changed with respect to now offering more flexible fee schedules. Now, in the past, it was available only to allowing only just to have one fee structure. Now that we offer three of them, basically 50, 75, or 100 basis points. The biggest thing I will point out is that there is now a spot on the application to mark that fee schedule. So if you don't mark it, then they won't charge anything. That is one of the things that we've noticed in the last couple of weeks for new applications that have come through. The other thing that goes along with that is that along with the new fee structures that come along with that, is that you are also available to 529s. 529 accounts are now available on this F2 Direct program. So basically from there, this allows us to for people who are utilizing or having issues with or determining what share class we would be using for different age levels. The advisory program basically eliminates that issue. Basically, what we're doing is now, because you're not paying an upfront sales load on any of those new transactions that are happening, is that eliminates the A versus C conversions, all the things that Rick Medlin may have reached out to with respect to and stuff. So that is something that is available that are a helping process here for the F2 Direct and stuff, F2 Direct program. So Kailee, I'm going to see if we can get you back here.
Can you hear me now?
Yes.
Great.
Okay. I went in on my iPad. I have no idea why my computer still isn't working, because it didn't work the last time I was on here like months ago. So I don't know. It's however the WebEx gets sent, but awesome. Well, I'm going to try to share my screen. Oh wait, I'm going to share screen, start broadcast. Okay. And then perfect. So bear with me 1 second here. All right, perfect. Well, thank you again for having me on the call. I do appreciate it. I know you can't see me anymore just because of me using my iPad, so sorry about that. But Prudential's really excited. We have launched the second buffered income rider that you guys have now on the platform. So Allianz Index Income Advantage is going to be the other income rider available. There's some things that Allianz can do in their income rider that we can, and vice versa. So this really isn't for anyone on the phone call that has been using the Allianz income rider. It's a really good income rider, but it is for a different type of client than what FlexGuard income would be for. So before I kind of go in to how it works, and we're going to do just very high level, I just want to kind of lay the land of what an annuity wholesaler goes through, kind of a day in the life of an annuity wholesaler. So I've been with Pru for 13 years and I've been annuity wholesaling for all 13 years. And every day that I wake up, there will be at least one advisor that I speak with, whether that's over the phone or in person, who tells me they hate annuities, right? They say, I hate annuities because they're costly, right? They cost a lot of money. They're very complex, and there's essentially a commitment of time. And so what we've really tried to do, and many of you know, is we really gotten out of the variable annuity space with income rider. And we really have kind of pivoted our business quite quickly over to the buffered annuity or registered indexed annuity space. And we've been very successful in doing so. And we have a really good, just plain Jane buffered annuity out there. But most recently just launched the income rider here at Harbor about 3 weeks ago. And so what we did is we really went out to the street and asked the street, if we were to build an income rider, and essentially we went after the advisors that don't love annuities or kind of hate annuities, if you will, we kind of asked them, if we were able to build an income rider, what would that look like and why would you sell it? And so those three aspects, or the three C's, came up: cost, complexity, and commitment of time. So I think we did a really good job at really nailing down all three of those kind of concerns. And I think you're going to be really excited to show what we have to your clients, especially for the ones that are going to need income here. For joint life, it's 1.45% all in. It is going to be the lowest income rider out there. And what's interesting with that is, a lot of times we don't use annuities with income riders for clients that are as young as 45. Why? Because most of the income riders out there are 2, 3, even some of them are 4% annualized, which that's a pretty large fee for a client to pay when they're not even using that income rider yet. With this being all in 1.45%, this is an annuity that's going to be able to be deferred for an extended period of time. You can defer it for 10, 15, 20 years, and essentially it's just going to be a little bit more than what a managed money portfolio costs. So by having that low cost, we're able to defer longer and not feel bad about deferring because of the underlying cost of the investment. So all in cost, 1.45%. Second is going to be, it's very simple. Your withdrawal rate goes up each and every year by the same amount every single year. It just all depends on when you open up the contract. So what you see I have highlighted on the bottom is age 60. And there is a 3-year wait time for this specific product. So 3 years minimum wait time. So what you'll see, and can I see if, oh, good, I can do the little red pointer. Look at that. Perfect. So down at the bottom, you're going to see that if someone were to open up a contract like this at age 60, their withdrawal rate would be 4.15%, but as you know, they cannot take income immediately. This is not an income tomorrow story. This is an income sooner, income later story. 4.15% is the withdrawal rate, and that withdrawal rate will grow by 35 basis points year over year. Now, what you'll see is after 3 years, so essentially the client's now 63 years old, we're able to offer a 5.2% withdrawal rate for the rest of their life. And if you see, I'm going to kind of go up here and you'll see that's why it says 4 right up here, right? 3-year wait time. So beginning of year 4, your clients can get a 5.2% withdrawal rate. And then you kind of just move the bubble across to see if they waited longer. So for instance, if the client wanted to wait till 67, they're at a 6.25% withdrawal rate. Now, I'll just quickly stop there and say, there is not a variable annuity out there today, like just a traditional variable annuity, that is going to offer your clients a withdrawal rate higher than 5% prior to 65. So when you take a look at really what the buffered income riders can do, they really can offer a higher withdrawal rate at a much younger age than the traditional variable annuities. Now, as far as investments go, you have 4 different indices that you can mix and match. You can choose the S&P, you can choose the ETHA, iShares Russell 2000, which is IWM, so just small cap. And finally, you can choose Invesco Triple Q, which is going to be your NASDAQ. You're able to invest this money however you choose. And for those of you that use our for those of you that use our FlexGuard contract today, you know that we have some pretty unique features. Most of our options that are available on FlexGuard are going to be uncapped. So in the accumulation phase, you can have an uncapped strategy to grow that asset as fast as possible and also to have some protection on the downside. Now, when your client is ready to take the income, there's really 2 ways to take the income. You can choose kind of the stable income route or the market rising income route. And just because you choose, let's say, the stable income route 1 year does not mean you cannot choose a different route the next year. So for instance, maybe the client really wants that predictable income for a few years and they decide to go with the stable income withdrawal rate. And then later down the road, maybe the market kind of took a correction and they want to reallocate their money into the market rising income, which is going to give us much more upside. you do have the ability to do that. So very flexible. What you pick is not what you get forever unless you want it to be. So stable income, what this is this is the income will never go down and the income can only go up. Doesn't matter if you choose stable income or market rising income, your income will go up as long as the market's positive. Hands down guaranteed. So stable income, it's going to be more of a depleting asset because as you can see, there's 100% buffer and it has very little upside. It's a 1.6% cap. Okay. So the most that your income can go up any year is 1.6%. In the market rising income story, the most your income can go up is 14% in any given year because that's the current cap rate right now. This also has a 10% buffer. In the market rising income story, your income can go up, but it also can go down. This is more of like a systematic withdrawal, but it is lifetime income. So very quickly, I'm going to walk you through the stable income and what that looks like through a market cycle, and then also the market rising income and what that looks like through a market cycle. And then finally, I'm going to, at the very end, bring this back to kind of what I've talked about at your national sales conference when it has to do with that mega Roth ability to save. So in the stable income, let's just pretend that the market went up 5%. Your client's income would increase by the cap. So your client's income increase would increase by 1.6%. And if we started with, and I'm just using these numbers, but started with a $10,000 annual withdrawal, our $10,000 annual withdrawal would have gone up by 1.6%, thus giving us an annual income of $10,160. Let's say the market goes up 20% like it has this year. We're still only going to get the small increase of the 1.6%. Therefore, income would be $10,322 going forward. If the market went down, let's say it's down 12%, nothing were to happen, and we'll just repeat that income from the previous year. Once the account value goes to zero, which it will go to zero in about 15 years, does not matter if you choose a stable income or the market rising income, this contract will go to zero in about 15 years. Why? Well, the stable income, there's really not that much upside, so there's really not that much growth, so it will go to zero in about 15 years. And in the market rising income story, because the payouts get so large because of the increases in income, because we can increase your income by 14% in any given year, that thing was going to pay out a lot of income and will go again to zero in about 15 years. Doesn't matter though, guys. When it goes to zero, your income would be locked in for life. So whatever your last paycheck was, is the income that your clients would receive until they were to pass away. So in this example, let's just pretend that the account value went to zero in this year. The $10,322 would be locked in for life. This is where the story gets pretty cool. There is no other product out there that's going to increase your income by more than 3%. Prudential can get you up to a 14% increase. And I'm looking at the same market cycle, just in a different strategy, more upside. So what I'm using here, guys, is I'm using the 10% buffer strategy with a 14% cap, and I'm just looking at the S&P. We do have all the other indices, but to make this story simple. So if the market went up 5%, again, we have the same $10,000 starting value. Market went up 5%, so does your income. Therefore, your client has increased their income by $500 for that specific year. Market goes up 20%. The client will get the full 14% credit because that's the cap currently. And the client would have close to about $12,000 of income. Now, if the market went down more than what the buffer can offer, your income will go down. So market goes down 12%. We are covered for the first 10% on the downside. So the first 10% is covered by Prudential. Therefore, your income would go down 2%. So you can see that there is a small decrease in income in that year 3. So let me just kind of go through this with you. Again, remember, the last check that causes the account value to go to zero will be the check that's locked in for life. There has never been a time in the last 30 years where your last check, meaning the account value has gone to zero, so now we're locking in that income stream. There has never been a time that your last check was not more than the very first check that you started with. Now, throughout those 15 years, while you were drawing out of this contract, Your income did go up and did go down in the market rising income option, but there has never been a time that what you've locked in for life wasn't more than what you started with. And the last thing to really put numbers on trial is Simon. Simon, for those of you that may not know, is an open marketplace for structured notes. Because Prudential has a structured annuity, this has been taken on by Simon to be back tested onto their third-party program. So this is not a Prudential program, but it has our product loaded into it. And what you're going to see is I'm looking at that 10% buffer with that 14% cap. And again, we're looking at that market rising income story. And this is going to back test it all the way from January of 1953 through yesterday's close of business. It looks at every single day and then a year forward. So rolling daily annual look backs. I know that's a mouthful. My point is there's 17,000 data points that I'm showing you right now. What this is telling us is that on average, this specific strategy, you can expect almost a 7% increase year over year in your income. Now, again, in those 15 years, as this thing went to zero, your income went up by 14% in a given year. It went down in 2008 by 28%. But again, if we look at this from start to finish, start being your very first check, finish being you passed away, on average, your clients should have gotten a year over year annual increase in their income by almost 7%. So talk about inflation rider. This is it for you folks, especially since things have skyrocketed with cost. Just even I went out to Chili's and I literally paid $15 for a margarita, which is crazy. I didn't realize it over the weekend, but I said to my husband, wow, inflation truly is real. I mean, we hear it all the time, but you know, things are getting more expensive. So in the traditional variable annuities, we're not going to have that inflation protection where we can get that here. So let me just kind of bring this home, and I'm going to turn it back over to Erin and everyone else here. So if you were in my little breakout session, we talked about the Mega Roth strategy. And many of you know that Mega Roth strategy may be going away here very soon. So it's going to be imperative to continue to grow our clients' Roth IRA dollars. Because if we're not going to be able to do it in our after-tax bucket, we need to maximize those dollars as much as possible. What not a better way to take a portion of someone's Roth IRA and reposition it into something like FlexGuard? As I already mentioned, you have uncapped strategies with acceleration on your returns in the accumulation phase. Currently, right now, we're paying 120% on the S&P. We're paying 220% on the ETHA, and we're paying 110% on the Russell. There is absolutely no cap whatsoever. Accumulate those Roth IRA dollars uncapped, then we turn on the income, and our income is going to be tax-free. So I'll stop there, but you know, the last thing I'll leave you with is think of their clients in your book of business that are between the ages of 45 and 60, who have at least 3+ years to wait, who do want to stay invested in the market, not only in the accumulation phase, but also when they actually take withdrawals, and they're looking for some lower cost options. Because again, all in 1.45% cost. So guys, I appreciate you having me on the call. Thank you for spending the time with me, and I'll turn it back to you guys.
I just have some questions that we take in the back office about this product.
Yep.
That I'd like to provide you.
Yep.
Specific to this rider, is there a specific FlexGuard strategy, you know, suggested or that would seem to work best?
Yeah, so I'm going to go back so this is going to be our most popular strategy right here. Looks like it froze on me because, hold on one second. Let me get out of here and then redo it. I have my my computer going, and I see that you guys can see it still says stable income. Bear with me one second. I'm just going to stop the sharing and then reshare if you don't mind. But yes, there is a specific strategy that When advisors are using FlexGuard, most times they're using our accelerated strategy. The accelerated strategy is going to give the clients the ability to participate in all of the market returns. We are never able to cap it, even when we renew rates. And the minimum participation rate that we can ever renew at is going to be 100% participation in the market. So what I'm trying to say is it's not possible for us to give your clients something less than what the market does. And this is going to be that acceleration strategy. So essentially the first 20%, and this is over a 6-year period of time, the first 20%, the clients always get dollar for dollar. That's kind of why it says tier 1, and then you see 100% there. And then anything above that, anything above 20%, the client's going to get that extra leverage or extra kicker or bonus onto their returns. So when you think about the S&P, and right now we're paying 120% on the S&P in that second tier of returns. As long as the S&P is averaging a little over 3.3% year over year, at least in our acceleration strategy that you see on my screen, your clients are going to do better than what the S&P is doing outside of the FlexGuard contract. All of these options are available in the accumulation phase. So when your client has 3, 4, 5, maybe even 10 years of accumulation, think about what we can really do on the upside of this product, only with a 1.45% fee drag all in.
All right. So as far as a client locking in gains during a term, they probably want to lock in those gains with a strategy like that.
That's correct. So in the accumulation phase, you are able to lock in your gains any day of the year, and then you're able to reinvest that money back into any indice on the next annual anniversary. When the client is taking withdrawals, though, there is not any lock-ins allowed. The way that the options are sold and the way that we have to do that on a month-to-month basis to give them that to give them that monthly paycheck, it's just not possible for us to lock in gains because it's very expensive. So in the accumulation phase, absolutely, you can lock in gains whenever you want. You turn on the income and you're able to continue to receive your income. But if you wanted to like reallocate in the middle of the year, you just can't do that. You just have to wait to the next annual anniversary to reallocate that money.
So when do rates change and when are they available? Is that usually every month?
Yep, rates can change every month. We've
Correct.
seen. Oh, sorry, go ahead.
No, go ahead. I said on a new contract.
On a new contract, the rates, so we have 1-year point-to-points, 3-year point-to-points, and 6-year point-to-points. So all of them will continuously renew. In the acceleration strategy, which you're looking at, the 6-year point-to-point. So of course that's going to renew every 6 years, or if a rate gets higher in the 6 years that you wanted to switch into, you can do that because you can sell out of your lower rate and then just go into that higher rate on that next annual anniversary. But rates will update on a month-to-month basis, along with your term expiring.
All right. And then are renewal rates on existing contracts different than on newer contracts?
Nope, they come in at new money rates or very, very close to new money rates. So we're able to show advisors. So we launched this product May of 2020. So we've had renewal rates to be able to show to advisors starting in May of 2021. And so we're able to show them side-by-side comparison on what the new money rates are to what our current rates are. And you'll see they're pretty much exactly the same. And actually, sometimes the renewal rates have actually come in a little bit better than new money rates, just the way that we purchased the options the year before.
Okay. How about when a client is transferring money? Do they get the rates when the app submitted or when the money comes in, or how's that work?
Yep. So we invest the money the day of. So there's not there's not any confusion on what rates they'll get. But as far as what rate they'll get, it's going to be we actually go by application sign date. So we're able to change the rates on the 15th of the month. So if you had your application signed on the 14th of the month, you would get that rate. The contract or the application has to get to us within 15 days of signing, but it is going to be application sign date. And no, we're a little bit different there than some other carriers.
All right. And I guess last but not least, Prudential's rating, financial strength.
Yep. So we're in all the top categories, AAA, so on and so forth. We have a Comdex rating of 94, which is going to be the second highest Comdex rating out of any insurance company that offers these buffered and fixed indexed annuities. And that's out of 24 different insurance carriers. So top ratings as well.
All right, great. I guess I'd open up to anybody else with questions.
Yeah, does anyone else have any questions for Kailee? As from our silence, they would say no, but thank you very much, Kailee, again. And thanks again. Like I said, anyone who has questions with respect to her product, you can reach out to her, or we can get you in contact. If you don't have her contact information, we can reach out to the home office and we can get you back. We can get you in touch with Kailee also. And thank you, Kailee.
Yep. Thank you, guys. I appreciate it.
You're welcome. Hey, so for other changes, just to get back on the theme for other changes that are coming up here, is that for people who are doing advisory billing, people who are managing the assets themselves, and clients and for advisors who were utilizing the billing feature of quarterly in advance for on their accounts, is that at month end or at year end, basically, is that those accounts are going to get switched over down to, instead of doing monthly or quarterly in advance, they're going to be changed to monthly in advance. Julie Nellis right now is in the middle of the process of, will be sending out an email to those advisors who are affected by this. And basically, what's going to be happening is that your quarterly bill has been taken care of for the fourth quarter now. And then basically, in a few weeks here, you'll be receiving an email about basically which accounts are affected. And basically, you will have a conversation with Julie with respect to any questions that you have with that. And then basically, the flip of the switch for in January will be that it will be moved over from the quarterly advance to the monthly in advance type of scenario. So just a heads up with respect to that. One other thing that internally at Harbor that we're doing, a service that we're providing that has changed a little bit also from the last time we've talked about it, is one of the things that Harbor had rolled out was a Harbor traded platform. So we know that all of the clearing firms on the advisory side offer a block trading platform. And again, if you're interested in looking more into those block trading platforms, you can reach out to myself and I can talk with you more about those for working on your own accounts. But the same token is that for people who are looking at this and are overwhelmed with respect to the to that block trading platform, is that one of the things that we can do at Harbor here is that we offer a bunch of models that are from our third-party vendors, and that those models will be Harbor will do the administration for. So I'm going to share my screen here, and just to give you a little bit more sense of what this is and stuff. So basically, for people for a rep managed account, is that there's it's a two-page addendum, and it's pretty straightforward with respect to this. And actually, the biggest thing that's going to be changing is that in the past we allowed only two fee structures, 50 and 100 basis points. Basically, in the future, we're going to allow, going forward here, we're allowing anyone to choose their fee structure up to 100 basis points with respect to this platform. But the biggest thing that goes along with this is that they have access to a bunch of these models. And as you can see here, is that BlackRock, First Trust, State Street, all of these companies offer different models that are actively managed. So State Street is managing the assets, First Trust is managing the assets, BlackRock is managing the assets. What Harbor is doing is Harbor is going to basically, we will receive signals from these companies about allocation changes, and you can see there in the middle column there is how often that these portfolios will be traded. So you can see on a quarterly basis, on a monthly basis, on an annual basis, is that these models are available to you. And as you can see here, is that they've got some low minimums, and these are great. The biggest thing that I would say with these models is that they are great for accounts that basically that you don't want to put a lot of time and effort into. I mean, for at least the management side of it, is that we can help you with respect to that, because as you can see here is that you can provide an actively traded model. You have multiple different strategies with respect to it, and with that, now you're able to work with, basically subset some of your clients, and especially some of your smaller clients, and being able to them have an actively traded account with respect to being managed by a third party. At the same token, you're not having to worry about doing the trading. You're not having to worry about basically the allocation. That's left up to the manager and stuff. The nice thing with this is that because all of these models are ETFs, is that with the BlackRock and State Street ETFs, typically you're going to range. Most of these models are going to range between 5 to 20 basis points of ETF cost, and at this point in time, we're running these portfolios through on the TD platform, and because of that, there's not any trade costs with respect to any of these with any of these trades or with any of these platforms and stuff. So the nice thing is that basically you have an all-in cost here of basically your fee plus just basically an admin, and then just a 15 basis point admin fee on top of that, basically for Harbor to manage that. So in essence, it's going to be, so if you put 1% on there, the client will be paying 1.15 with respect to the cost for the program stuff. If, like I said, we've got some very well-known name brand models here, or asset managers and stuff that we basically are working with to provide you with solutions for this. And these are great for, really good for small count solution type of scenarios and stuff. But yeah, the nice thing with this is that in the past we had limited the amount of fee schedules that were offered. Going forward is that basically the flexibility is back up to you. So really, in essence, it comes into being is that anything up to 100 basis points is available to you, and you can pick and choose what you want to do. There's a 15 basis point admin fee that goes with it, but at the same token, now you have access to all of these managers that basically without having without any trading costs that go along with that. So if that's something that you have questions at this point in time, you can ask me now. If not, you can reach out to me too, and we can talk through. I can get you more information with respect to all of these platforms or strategies and stuff. It's been a great strategy. It's been great to work with these companies, and so we're looking forward to helping advisors, especially with a small account solution. And right now we're running this through the TD platform and stuff. So someone asked where the form is. Basically it's not on our website at this point in time. What I can do is I can email that to you going forward. I can email that to you after the call here. Also, basically is that I can send you out for performance if you're looking for performance numbers for the different models and stuff. Is that basically what we can do is I can get you access to the performance numbers. They're on iRebal. So basically where these are found, you can find them on iRebal, some performance numbers in the first place, but also at the same token, I have direct access to First Trust or State Street or BlackRock to provide you with the most up-to-date, the most current performance numbers for that. So yeah, so this is definitely it's very straightforward. The nice thing with this platform is it's very easy to change. Is that one of the things that we're offering the flexibility with this platform is that if you wanted to switch portfolios, if you went from one portfolio to the other, it's basically what we've done is that the client will, when they sign off on here, is they're going to sign off on you, allowing you to have the ability to switch the portfolios for the client. You know, you will have the content and be in communication with the client. Then basically, without having a new signature, is that the client can move from a BlackRock ETF portfolio to a State Street portfolio. So again, a lot of flexibility, very easy to use. It's just the biggest thing is with this is that low cost, lots of great attributes to this program and stuff. So if it's something that you are interested, please give me a call, reach out to me, and we can work through any of those questions that you have. See if I can check the chat here. So I had questions. Yeah, performance numbers. Are they incorporated into Riskalyze? That'd be something I'd have to look into, Robert. I know that was a question that came through on the chat. With that, so what we'll do is, yeah, I'll take that offline with myself and stuff, so we can do that. So yeah, I mean, again, there's been a whole bunch of changes and a whole bunch of things going on here for the end of the year. I don't know, or one of the other things I was going to mention before we jump off the phone here is that from now through the end of the year, there's going to be a lot of travel. So Harbor staff will be traveling for holiday parties and transitions, things like that. So the biggest thing I would advise you is that if you're looking for somebody or need a question answered, is that Harbor does have some general email addresses. We do have advisory at Harbor INV. We have technology at Harbor INV, Morningstar, new business, commissions, all those generic email addresses that will be sent, that will go off to multiple people, so that we can answer your question. Just a heads up for that. So if you're looking for somebody, it's definitely going to be going forward here, or at least through the end of the year here, we're going to have, there's going to be a lot of people in and out, and especially with the travel that's going on here. So I just wanted to give you a heads up with respect to that. So does anyone have any questions? Anything that has come up? Anything that we've talked about here before? I'm checking through the chat line here.
While you're checking that, the most common annuity we sell would be a 5-year fixed annuity, as far as on the fixed side. And that rate's at about 2.75. Give me a call and we can go through that. If you're looking for something with a little more upside potential, I mean, they do have index annuities with S&P caps at 5, and it's around a 7-year surrender charge schedule. So again, just reach out to me as those situations come up.
Mike, we had a chat asking about the notice. This was in regards to the transition of the fee schedule going from quarterly advance to monthly. I will reach out to you with respect to that. I'm not sure. I'm not sure if we're doing it or if we're having the advisor do it. But either way, I'll talk to you with respect to sending that notice out for the change of the fee structure, or the billing frequency that's going to go with this. So again, I'd like to open up to anyone else that has questions. I know there's been a lot of great information here today with respect to Kailee with Prudential, just with the mergers from Marketing Pro, the change with American Funds F2 program, the Harbor traded platform, lots of good things that are coming on, lots of good things that are happening here. With the iRebal for TD users has been updated too. So there's a new look and feel that goes along with that. If our people are wanting to in 2022, looking into trying to provide their, be a little more efficient with respect to trading for their advisory accounts, is that please give me a call and I can help you walk through any of the trading platforms that are at at Pershing, Schwab, TD, whichever platform that we're on here. So, again, I'd like to reach, if there's anything else that anyone has for questions, comments. If not, again, I'd like to thank you for your time and effort here today. And thanks for joining us. So Jeremy and I, we're glad to be here, and thank you much, and have a great day.
Have a good day.